Beginning June 1st, State Farm can temporarily raise its rates by 17% for homeowners, 15% for renters and condos, and 38% for rental dwellings.
Last year, Jessica Carson and her husband purchased their first home, a 3-bedroom condo in Castaic.
And we feel like we are being forced to leave. And we don't want that to happen.
The reason? A nearly 900% increase to the complex's fire insurance policy. The premium went from $43,000 in 2020 to roughly $430,000 in 2022.
Large home insurance providers, including Allstate and State Farm, are no longer providing new home insurance policies for customers in the Golden State.
In the wake of Southern California's deadly and devastating fires, the state's insurance commissioner is now facing questions about why he took a trip last week to Bermuda for a conference with insurance executives. Commissioner Ricardo Lara was asked to appear in Sacramento at a hearing with state lawmakers, but he instead chose to go to Bermuda.
California's insured last resort, the FAIR plan, has run out of money to cover claims from devastating LA fires and will receive $1 billion bailout.
And this is why 100,000 Californians lost coverage between 2019 and 2024. You know, State Farm, they dropped 70% of their customers around the Santa Monica Mountains. Just the Santa Monica Mountains, Maria. Yeah. This is what's happening in this state. There is no money. Yeah. And FAIR.
Not a shocker. California home insurance premiums will jump 16% this year, the steepest of any state out there. What's the deal? Well, I think you kind of know. Let's get into the specifics. Here we go. Yeah, so this is just a massive, massive increase. Remember when we did all those podcasts? And if you're new here, thanks for joining. When we did all those podcasts on California insurance industry, and we had insurers pulling out left, right, and center to the point where California was basically just insuring with their own insurance, their own publicly, state-run insurance, which was expensive and didn't really have much coverage because homeowners didn't have too many other options. Most all the major carriers had pulled the plug and said, hey, too much risk, and it's too expensive in California. And with the way that California allows insurance companies or dictates, regulates how insurance companies can get premium increases through the system, through the California insurance system, a lot of those companies just didn't increase their rates. They're like, can't do it. And then it got to the point when you had the wildfires where insurance companies are like, hey, you guys got to switch this around because we don't have the money and we're not able to get reinsurance policies on insuring in California because you guys are such a risk to begin with. And then also rebuilding in California is so expensive and we're not able to recoup with the premiums we're able to charge. We're not able to recoup what we need to stay in business. So we're out of here. And they basically said, we're leaving California. And it got down to just a handful of insurers. Well, this is things kind of going back the other way. This is cases in court. In the California insurance system court, they've got their own, like a lot of things in California, they've got their own little, system of overregulation. Gap between California and the national's forecast is stark. While most Americans can expect about a 4% premium increase in 2026, California is 4 times that, 16%. It's the fastest rising state in the company's data set. Distinction tied to the state's concentrated wildfire exposure and the cost of reinsurance that carriers purchase to cover catastrophic losses. So an insurance company gets insurance on their insurance. Reinsurance, right? And they're not able to get it on a lot of stuff in California because people are looking at a map going, well, that's probably going to burn down the road. So here's the cost, cha-ching, for your reinsurance policy. And then State Farm says, oh, no go. We need more in premiums to make this go because we can't afford this. Therefore, it's not viable. Now, a lot of people are like, I think the insurance companies are charging too much, and what they give us when our house does burn isn't isn't an amount that we can actually use to rebuild our home. And folks in the Palisades fire are experiencing that right now. They're not able to rebuild. Things are too expensive. Difference between insurance coverage and what they're getting is such a stark difference that they're like, ooh. And that's why you're seeing so many lot sales, because people are like, I'm out. I don't want to spend years and years rebuilding, and I don't have the money to do it from insurance to begin with. So what are we doing here? Selling a bunch of vacant lots. The practical effect for a household already stretched by high housing costs is immediate. If you had a $2,000 policy, which I'm not sure where in California that is, but it's certainly not in your major metropolitan areas, $2,000 a year would face roughly $320 more a year under the projected increase. For borrowers with escrow accounts, the adjustment flows directly into monthly mortgage payments, because if you've got a mortgage, you get a homeowner's insurance policy that basically covers the lender, right? Covers the lender. Then they allow you to take that money and rebuild your home, often with little advance warning beyond a revised annual statement. Question regulators face is whether approving higher rates keeps insurers writing policies in fire-prone areas or in any areas at all, or simply prices residents out of coverage altogether. Neither one a good option. Would you like no insurance or really expensive insurance you can't afford? Do I have a choice? No. The answer is no. You don't have a choice. This is one of those many bits and pieces of the puzzle of overregulation, to the point where you've got a situation where insurance companies are like, the numbers don't fly. We cannot make these numbers fly. We're out of here. We're done. And they can use that leverage basically to their advantage, because you need insurance companies insuring, because it's a thing. Got to have insurance. If you get a mortgage, got to have an insurance policy, right? No insurance policy. No thanks. Pass. Hard pass. No lender is going to go down that road. So, article goes on to say some owners may raise deductibles or drop optional coverages to keep bills in check, potentially leaving themselves exposed after a major loss. Others could delay maintenance or upgrades that might otherwise reduce risk, such as replacing an aging roof or creating defensible space around a home in the wildland-urban interface. And for those of you not in the wildland-urban interface, unfortunately, you are paying insurance premiums that cover those people. You get lumped in together with everybody in California. And that's why your insurance premiums are so high. Now, you've got other states that have high insurance. Texas, some of the highest in the country. And a lot of it has to do with, big storms coming through and damage, replace that roof every few years. See how that goes. Insurance companies got to pay for that. You got a bunch of hail damage. That happens all the time. You got, softball-sized pieces of hail that come out of the sky. Oftentimes they're golf ball sized. And if you've been through one of those, and if you've seen the damage on cars, terrible. Just dents up the paint, dents up the car, destroys the windshield, destroys glass. Have your cars covered, right? Have your cars covered. My parents park in Oklahoma, and they've got storms as well. My parents park both their cars in their garage where you're supposed to, because they need to have their cars, and most of their neighbors do as well. The only car you leave out is like maybe your kid's car. I don't really care about that one, because you could have storm come through that just, wreaks havoc. Long-term concern is that premium shock, like 16%, layered on top of mortgage payments, taxes, mortgage payments, which are already high because you're in California, some of the highest housing in the nation, taxes, some of the highest taxes in the country, and some of the highest utilities in the country. You layer those all on with now 16% insurance increase, erodes overall housing affordability in a state already struggling with high costs. Yeah, this is more leading to more. It's already really expensive. Now that's going to get even more expensive. So State Farm proceedings reveal the regulatory pressure. This is from a State Farm rate case. It's been going through the California Department of Insurance. Commissioner Ricardo Lara adopted a judge's ruling on State Farm's emergency request. State Farm came in and basically said, we need to up these premiums by asking 25 or 30%. I can't remember. It was a high number. And you're like, oh, there's some sticker shock. Approving an interim homeowners rate increase that differed from what the company originally sought. They wanted more, they got less, but not as less as the state was saying, hey, that's not reasonable. The proceeding balanced two competing demands. State Farm solvent, enough to offer continued coverage, while shielding policyholders from costs the department considered excessive. Well, a lot of these insurance companies have not raised their rates because the way that you do that in California is such a nightmare. And companies basically said, we're going to be out of California. We're not going to do California. So this is kind of that case that went through the commission, and the commission came back and oh, good Lord, we got to explain this to our people, but looks like about 16%. To the moon. That interim approval did not end the dispute. Department of Insurance, Consumer Watchdog, and State Farm reached a settlement that modified the previously approved interim rates. Deal includes specific percentage adjustments along with refund and interest provisions for policyholders already charged the earlier interim amounts. Settlement signals that even approved rate increases remain subject to revision when consumer advocates and regulators push back on their underlying actuarial justifications. Hey, we know that your numbers say that you need this amount of money, but it's too much. It's too much for people to pay. And then what's the end result of that for the insurance companies? They pull out. Your supply of insurance companies gets restricted. What do your rates do? To the moon. So while they're already going to the moon, they're going to the moon even more. I mean, really going to the moon. Not like that 1960, whatever that was. 69 thing. Know what I mean? Yeah. Full detail behind these approvals sits in company filings housed in the CDI's public filings portal, where actuarial memoranda, loss development exhibits, and requested rate levels are available for review. God, I bet that is some exciting reading, right? You got wildfire losses, you got rebuilding costs, you got reinsurance expenses, feed into these models to produce a new base rate. So, small changes in projected catastrophe frequency or claim severity can translate into hundreds of millions of dollars in additional premiums statewide. And that's what we're looking at. You're looking at some massive increases just overall. And this doesn't even get into what are the premium rate increases going to be down the road. This is just the next year. I mean, it's wild, right? I mean, and by that, I mean, what's going on? In a state that already suffers with poverty, with people not having unemployment, people not having jobs, high housing costs. You know, the list just goes on and on. Because of policy, because of the way things have been handled, arguably, like here in Washington State, things are more expensive than they need to be. Like the cost of gasoline in California, way more expensive than it needs to be. But it is what it is. Insurance doesn't need to be this high, but with the way things have gone and California allowing homes to be built in wildfire designated areas, and then basically not keeping, minimizing the risk, not thinning out forests because, got to let the forests do their thing, which basically means they're just one big tinderbox waiting to go up. And that's what we had in the Palisades fire. And then no water in the reservoirs. Mayor Bass in Ghana. You're left with, all right, if I was an insurance company, I'd probably jack those rates up too, because something's going to happen down the road. And based on what we just experienced with the Palisades fire, results aren't going to be good. Settlement still leaves rates higher than they were before the emergency filing, reinforcing the broadward upward trajectory captured in statewide projections. For homeowners budgeting month to month, that combination can be confusing. Temporary credit might mask the underlying increase. What they're saying is they've had these rate changes already since the original ruling and agreement, and then they came back with something else. We're going to give you a credit. Now we're going to charge you more. We're going to give you a credit. We're going to charge you less. One of those deals, right? Looking ahead to 2026 and beyond, 16% jump in 2026 underscores a tension that is unlikely to fade. This isn't going anywhere. This is only going one place, and that is up. There's no way this gets cheaper. It's like a Democrat Socialist of America saying that they're actually going to have a positive impact on affordability. What are you going to do? Take housing, for example. What are you going to do? Make builders build more homes? No, not happening. Just not happening. Just not happening. You're going to create city-run grocery stores to bring the cost of groceries down? Well, no, it's just taxpayers' dollars being funneled into something that you don't really need. But you're going to do it anyway because, socialism works for those who don't. So you got this model that can it keep pace with the pressures driving premiums higher that remains uncertain? If losses continue to mount, more carriers seek double-digit increases, test the limits of regulatory tolerance, or restrict new business in the riskiest regions, or just pull out entirely. I don't think so, guys. We're going to take our toy boxes, toys in our toy box home. We're leaving. We're going home. No can do in California. For now, combination of rising base rates, more intensive oversight, and occasional refunds leaves California homeowners navigating a volatile insurance landscape, just as the cost of protecting their largest asset climbs faster than anywhere else in the country. I mean, this is not a shocker. This is like, and when I read this, I originally thought, for some reason in my head, I originally thought it was 26%. And so when I was doing prep work for this, I was like, 26%, that's a lot. And then I got back to the article and I'm like, 16%. Oh, that's not too bad. But I'm not paying that premium increase, right? That's a big jump. Don't care who you are. That's a big jump. That's like on an annual basis. Oh, wow, that hopped up. But it's because the numbers don't jive with reality. What the insurance companies, are saying it costs them to run their business and run their reinsurance rates relative to the payouts, especially from the wildfire issues, because California's got pretty moderate weather. All in all, California's got pretty moderate weather. Same with Washington, same with Oregon. So it's not necessarily weather related, but it is because you've got these areas where, homes have been allowed to be built, and then the forests, you don't have typical maintenance of the forest that reduces wildfire risk because, you got a bunch of tree huggers who are like, oh, we can't have that. Can't have them trampling on the poor, fawn and fauna, Can't have that. We can't do controlled burns. We can't get rid of the underbrush. We're not doing any of that. And then you have the Palisades fire and you've got no water in the damn reservoirs, and you've got Mayor Karen Bass off in Ghana. Perfect. That's just epic. That's just great. So this is one of those stories where reality hits the road. Insurance companies say, no. And you might say, well, those insurance companies, they're just greedy bastards. All right. Yeah. But you need them. So what's it going to take? This is, for right now, what this is going to take. 16% increase. Steep. And things are already high. And everything else in the ecosystem of California is already high, by and large, compared to other states. You've got areas of California that have affordability, but those are, inland, and they're not on the coastal part. And same thing with here in Washington State. We've got areas that are pretty affordable as well, but folks don't want to live there. They want to live in the big cities. They want to live on the coast because that's where all the natural beauty is. You got the ocean, you got the mountains, you got freshwater lakes, you got but it's going to cost you. And home insurance, massive component, because it's not like one of those things where gasoline. Okay, I'm just not going to drive my car. You don't have that option. This is a cost that most folks with the mortgage, and most people have a mortgage if they're a homeowner or, lender on a non-owner occupied. This is unavoidable. So this is an unavoidable increase, and there's not a way out. There's no exit policy. There's no way to keep this more affordable, because we're looking down the barrel of, all right, this is happening now. This is only going to happen even more as we go on, because things aren't getting any cheaper. They're getting progressively more and more expensive, and it will drive people out of California because we've already seen, folks leave in droves, and they're going to elsewhere. And it's not because of just homeowners insurance. It's the whole kit and caboodle, right? It's the whole package. But, one more this is kind of just one more ding, one more notch California's belt of, we're number one in insurance premium increases on your home. Oh, that's going to leave a mark. California folks, sorry, but this is one that had to be done, right? Because it's important. Because it also reflects on the rest of the country. Oh, what's California doing? Well, it's not going down. All right. That's it for me on this one. Thanks so much. Love to have you subscribe, do all that good stuff. We'll see you on the next episode. Bye for now.